We'll put up a pie chart about how much of your shipments are domestic, how much are with Mexico, how much with Canada, and ask you, as we see so much uncertainty about trade, whether it's Nafta or whether it's more broadly, how that might affect your business.
Yeah, well, 40% of our business originates or terminates outside the United States. So trade's a very important part of our business. And if you look globally, Mexico is maybe 11, 12%. Asian trade off the West Coast is a fairly healthy portion. We've got some trade with Canada as well and other parts of the world. When you dial that back down in towards Nafta, Nafta is critically important to us. We enjoy about 70% of the to and from rail-based freight with Mexico. And the inextricable links between our economy and the Mexican economy in supply chains, in kind of the growth of a healthy middle class of consumerism, that's very, very important, and we support that, and it's very important to our business.
So are you seeing any diminishment at all because of the uncertainty over Nafta? I mean, nothing's been done yet, whether it's Nafta or China or any of the trade issues, but there's a lot of uncertainty on the part of other CEOs about their supply chains, for example. Do you see people dialing back?
I don't see anybody dialing back yet, but I hear a lot of concern. And I hear that concern from both U.S.-based businesses as well as Mexican-based businesses. And the concern is about the future, whether investments made now are going to be able to generate a return into the future and be secure into the future. The way we look at Nafta is we think it's an agreement that can be modernized. And in modernizing it, you know, the dispute resolution could use a little tweaking. There's a couple of other elements that could use tweaking. But overall, it's been a tremendous success in growing U.S. jobs and in growing exports and imports from both Canada and Mexico.
Has it prevented you from making any particular business decisions?
That is, the current disputes. They haven't prevented us from making business decisions. They've made us pause and think a little bit more carefully about what's going on. For instance, we just announced our biggest single capital investment in the United States in Brazos. $550 million to create a terminal. That's really all about Texas and the carload market in and around Texas, from industrial chemicals to the housing market to what's going on in the Permian. Part of that also does support Mexico, and we've actually paused that investment for a couple of years because of some of the uncertainty that we were feeling.
So let's dig into the different areas of your business. If we can pull up sort of the volume growth you're looking at for the first quarter, you can kind of see where you're quite heavy in the business, like energy, industrials, as well as premium. From where you sit, is the economy overheating? Is inflation a huge risk?
The economy is not overheating, and I do not yet see inflation as a huge risk. We do see commodity prices increasing. We're experiencing a little bit of inflation pressure. But what we see is a pretty healthy economy. We see an economy that used to be at 1.5% and 2% GDP growth, now approaching 3% GDP growth.
Sustainable?
I'm hoping sustainable. I think there's some other issues there that have to be addressed. One is the workforce. That's both about making sure the United States citizenry is capable of doing the jobs that we have going into the future. It's about immigration as well. We're going to have to augment our citizens to build a strong workforce.
Well, what about your situation specifically? Are you finding the workers you need with the training that you need to have them have, and are you having to pay more for them?
We are having to use signing bonuses in some areas of the country to attract the right people to the right jobs. Largely speaking, we can find the workforce we need. But there are certain areas of the country where unemployment's very low, and there are not enough people in the pools that we've been traditionally hiring from. So we're having to aggressively find ways to increase the pools. We're also having some difficulty in some of our skilled trades like diesel mechanics, electricians, et cetera.
So let's talk about exactly your business. How much of it is dependent upon energy, and how do you see that developing over time as we talk about cutting back on fossil fuels, for example, cutting back on coal? How sensitive is your business to that?
Yeah, so if you think about our business, we thrive when consumers consume things, when the producing economy is active and vibrant, and when trade is going on. Part of that is energy, but if you look at our energy-specific business, let's say coal, that's already reduced by about half since the heydays, call it 8-10 years ago. Right now, energy for us is coal. It's still a very attractive piece of business, but it's also the activity in the Permian Basin, whether that's frac sand in or maybe crude oil out or rock going in to build pads. What we really care about is making sure that the consuming economy is healthy, our producing economy is healthy, and that we've got good, open, free, and fair trade with other countries.
So you mentioned the Permian. Part of that's takeaway capacity, so not enough pipeline capacity to take away all the natural gas and oil. How do you compete versus, say, trucks? And how does your business benefit when the Midland-Houston spread sort of blows out?
Yeah, so let's stay on the Permian, and then we'll talk about trucks separately. In the Permian, the way we help that basin compete is we send frac sand shipments inbound. For us, that's mostly out of Wisconsin and Minnesota, northern white sand. We do some brown sand in other basins. And we also can help outbound when pipeline capacity is restricted. Right now, we're getting a lot of demand for crude oil outbound. And we have to be careful there, right? Because that'll be a short-lived business cycle, and we have to be careful not to make investments that ultimately don't have an ability to generate a return because they were only used for a short period of time.
So talk about trucking. To what extent is that a constraint on your pricing ability? Do you have pricing power?
Trucking is a wonderful market for us right now. So we are truck competitive in a fair amount of our business. It's not just domestic intermodal. It's really any manifest carload piece of our business is truckload competitive. That market is constrained right now, and that gives us both volume opportunity and pricing opportunity.
So if you take a look at your operating ratio, the goal is to get to that 60%. Talk to me about how you're doing and unit labor costs.
Yeah, so we're doing okay, I would say. We've made progress again on improving our operating ratio. We've got a very attractive operating ratio based on history and based on competitive environment right now. I think as we look forward, there's all the opportunity in the world to continue to be more productive. And it's not just about labor productivity. It's about asset productivity, fuel efficiency. There's a number of projects we've got underway in this thing we call Grow to 55 and Zero, which gives us a lot of confidence that we're able to continue to improve our operating ratio and ultimately hit a 60 and then ultimately move below.
You mentioned about your investment or deferment of investment in Brazos. Are you investing more capital because of the tax laws?
We are investing more capital, and the tax laws certainly help. And if I look at the end game for our tax reform, it's that we're going to have a more vibrant economy, which is great for us. That will prompt us to make investment and hire, and we have great paying jobs, and we generate an attractive return out of those investments.
Unit labor costs? Your unit labor costs?
They are, of course, going up. We collectively bargain for our labor, and those collectively bargained contracts are increasing wages.